and CPA Marc Allen, and Senior Manager Advisory and Tax at Rehmann, Laura Coston. Welcome back to the show.
Thanks, Marc.
Thanks for having us.
Yeah, nice to have you here. Thanks for your partnership at JTV with Rehmann. We appreciate that very much, and we appreciate your expertise for our viewers. And we're still trying to figure out the one big beautiful bill. I think we're still seeing a lot of questions about it. When they say big, they meant big, didn't they, Marc?
Yep, there's a few pages out there to read through to get through all the new changes that were implemented. So, yep.
It makes you wonder, did Congress, did they actually read this before they passed it? They're probably learning things about it every day like you are.
Yeah, for sure. I mean, I think they read parts of it, probably went over certain areas and focused on certain areas. But yeah, without a doubt, it's a lot to it, that's for sure. Luckily, we have experts and specialists at Rehmann that went through the bill for us and kind of broke out the details and let us focus on what areas we need to be focused on. So,
one of the things I think we heard all along through the period of passage for this bill that it was very business-centric, business-friendly with a lot of advantages, tax advantages for business. Let's talk about what benefits business are going to see in the one big beautiful bill.
go ahead and get started.
Yeah, I think one of the big ones you're going to see is the research and experimental expensing, also known more commonly as R&D expenses through Section 174. It reverts back to where businesses who are doing these activities and spending these funds can immediately expense the R&D expenses in the year incurred, where the last 3 years, 2022 through 24, they were required to capitalize and amortize them over a period of time. So that's huge for these businesses from a cash flow perspective, saving on tax dollars today.
Now, with the R&D, were those provisions already in place and that were due to expire?
So they were, when did it change? 22, it changed from an immediate expense, to being capitalized. So now it's reverting back to what it was back in 2021. And there are provisions to retroactively apply that for 2022 to 24, where businesses have been capitalizing and amortizing these costs over the years. So they can now go take all those expenses and expense them either in 2025 or 25 and 26. And then there's special provisions for small businesses with gross receipts under $31 million, where they can go back and amend 22, 23, or 24 returns and potentially get a refund and some cash back in their hand today.
So types of businesses we have in South Central Michigan?
Yes. Yep. There's a lot of manufacturing involves R&D expenses as they're exploring their products. It affects a lot of them.
What about the deductions? What kinds of deductions for business are in the big beautiful bill?
Yeah, one of the big pieces, accelerated bonus depreciation that we've been talking about for years, but that's been phasing out over the years. So through January 19th of 2025, you were only able to accelerate or claim bonus depreciation on 40% of that cost on your asset. Now anything that's acquired January 20th or after, you can claim 100% bonus depreciation. So anybody that's out looking to, invest in the company, purchase any equipment, anything on that side, now you can write that off immediately at 100% going forward, and that's now kind of been made permanent, so we don't have to worry about the phasing out and how do we write off some of these expenses where we're timing our income along with the expense, because we don't want to spend money but not be able to deduct that cost in the same year where we're getting some income tax surprises or anything on that side. So that was the big change that came out. The other piece there is the qualified business income deduction. So a lot of people have been talking about When corporate tax rates went down to 21%, they added in a pass-through entity deduction. So anybody that wasn't a corporation, you only had to pay tax roughly on 80% of your income, and you were able to reduce that net income by 20%. Well, that was going to lapse after this year. So everybody was concerned of, hey, do I want to stay as a pass-through entity? Should I change myself over to a corporation so that we can get that favorable tax deduction, as a corporation's got a much lower tax rate? They've done away with that, and now they've extended that qualified business income deduction where people don't have to worry about that anymore. So,
are these deductions intended to incentivize businesses to expand, build, create here in the United States?
yeah, definitely in the United States is a big piece of it. There's one other expansion part of the bill that they added in there was qualified production property, which this is a piece where you can actually write off even building expansions. So if you were going to go build and expand your operations to a new building, usually you have to depreciate that over a 39-year life. So you might spend a couple $1 million, but you can't write it off all immediately. Now, if that's a domestic requirement and you're putting that building in service here in the US, you're actually able to deduct that at 100% immediately once the building's in service, as long as you have the qualified production activity requirements, which a lot of these are your manufacturing companies that are looking to expand businesses and put up a new building. You might be able to have a multi-million-dollar write-off right away that first year.
All right, let's talk about how the bill impacts individual taxpayers, Mr. and Mrs. Average Joe. What are some of the things that people will notice when they do their next year's filing?
So I think one big one is the state and local tax deduction cap has increased from 10,000 to 40,000. So these are for itemizing taxpayers who itemize their deductions. There are some income phase out, so you can go up to $40,000, but it starts phasing out if you have $500,000 of adjusted gross income, joint, or 250 if you're a single filer, and then it's fully phased out once you hit 600,000. So that can be a good one for maybe your median income family. Maybe not the most beneficial for somebody in Jackson County, but if you look at those higher state or higher tax states, like
essentially a deduction for the local and state taxes you're paying.
Yep.
And your real estate taxes in there as well. Mm-hmm. So a lot of individuals were capped at that 10,000. They couldn't claim anything above 10,000. Now you can actually expand that up to 40,000 as long as you hit that. You're below that modified adjusted gross income exclusion amount, which is 500,000. So,
how about for charitable contributions? What kind of deductions and I guess thresholds are there for that?
Yeah. So the one nice piece that they put in there is, historically, it's been hard to itemize your deductions with this tax cap that we've got in there. So they've added in that single individuals can deduct up to $1,000 regardless of whether they itemize or not. So they can deduct their first $1,000. Married filing joint couples can deduct the first $2,000 as a non-itemized deduction. And the good thing about that is you're getting money back out to the charities that I think did feel a big crunch once the charitable deductions became a little bit less impactful on the tax side. So that was the big piece that's out there. But we're still always looking at, if you now itemize your deductions because you're allowed to claim the taxes, well, then it makes those charitable contributions much more impactful. So we should see a big swing on that side as well.
People in the hospitality industries, they are hearing they're getting some relief by not having to pay taxes on tips. That's part of the bill, right?
Yes.
How's that actually going to work?
So that comes through for people in that industry who are earning tips. It comes through on their tax return when they file it come April as a deduction. So an employer is going to be required to divvy out on their W-2, this is your wage, here's your tip income, and $25,000 per return is deducted from their income, so therefore not taxed.
So it's more record keeping then for for both the server and the restaurant, right?
Yep, definitely more record keeping, more administrative burden on a restaurant or an employer, but definitely recommend our servers track their earnings so that they can make sure it's done correctly.
We're seeing out of Lansing, we have no idea what the new budget is. It's supposed to be done today, but there's been rumors that among the things being considered are business tax provisions that would wipe out some of the savings of the federal big beautiful bill, and also some added incentives for servers in the no tax on tips on a state level. How does this impact, overall for your clients, trying to make decisions, strategize about income, expense, revenue, when there's so much up in the air this late in the tax year?
Yeah, it's been a challenge over the years. I mean, you see bills that are passed at times late December, that are retroactive all the way back to January 1 of that current year you're in, and how do you plan for that? Because we've been operating the first 350 days at one level, and then all of a sudden you've got to swing the last couple weeks of the year. So there's questions out there. There might be one big beautiful bill number 2 that's on the horizon. So we've got that's over our heads too, that there might be more coming in. But it does make it complicated for businesses. I mean, I think right now we know what the one big beautiful bill is out there. We know what the tax law changes are today that are potentially in place. So those are how we operate. That's how we function, and continue to tell businesses this is what the guidelines that we want to do today. And if it changes, then we make calls immediately and see what we can do if we have to pivot or go in a different direction. So,
Marc and Laura, when you look at all of the things in the bill, what would you say you are most excited about in terms of the benefit to the clients in your practice?
Yeah, I would say the biggest thing on my side is with the extension of a lot of tax laws that were in place, I think we don't have to come up with what is going to happen in 2026 if we didn't put the one big beautiful bill in place, because there was going to be a lot of increased taxes due for a lot of clients and a lot of businesses that were going to really feel a hurt on the cash flow of their business. And now that's kind of been put to rest, and there's additional opportunities out there now where you might be able to take excess deductions and move those back and recoup some tax you paid in prior years and everything on that side. So I think cash flow wise, definitely were some major improvements to help out on that side.
What do you think, Laura?
I have to agree with Marc. I think the cash flow and some of the provisions that, like bonus depreciation that Marc talked about, or this R&D, can free up cash so our clients can reinvest that and grow their business if that's where they want to go, or invest it otherwise.
Well, one thing's for certain, we're still going to need qualified tax professionals, as it's obviously a very complicated piece of legislation. People have questions, need assistance. I know that you guys are glad to help.
Absolutely.
Yes, for sure.
Great to see you both. Thanks for coming in today.
Thanks, Bart.
No problem. Thank you.
You bet. From Rehmann, CPA and Principal Marc Allen, and CPA and Senior Manager Advisory and Tax, Laura Coston.